I just want to talk about the valuations, because as you know, now market is like all-time high after all-time high, right? People are asking like, oh, are we in the bubbles? Valuation is so high, we should time the market. So let's just take a snapshot of today's, look at the portfolio, look at the valuations as of now, and then let's see what we should do at current moment. Let's review the market first. S&P 500 now is like 6,584. So definitely all-time high. If we look at QQQ, currently is at 586.66, also all-time high. Market has been rallying for quite a few weeks already, definitely very bullish. So if we take a snapshot of the market cap of all the largest companies, Nvidia definitely still number one at 4.3 trillions. I think this one is like zigzagging for a while, right? Microsoft is actually came down a bit, but the one that rallied quite a fair bit is Apple, Google, and also TSMC and Tesla. So as you know, I have positions in those names, right? Like Apple, Google's, I have all these. Then I also have TSMC and Tesla. So definitely portfolio has been doing quite well. So I think it's like almost first half of this year, right? I look at my portfolio returns also partly because of US dollar depreciated against Sing dollar, right? So my portfolio also took a hit. So I think first half of this year is like almost not much return. Then suddenly over these past few weeks, it's like almost like every day is like green day, right? So now portfolio returns is actually quite good. I think it's still like single digit, but high single digit now. Definitely, I guess you guys watching your returns should be also quite good, right? Depending on your specific stock picks. So let's look at valuations. So as usual, valuation, the first number that people will quote is definitely the PE. And for your information, for my purpose of sharing, right, I will just mainly focus on the US market. So S&P 500 PE currently at 30.55. So if you look at this level, right, compared to historical level, definitely considered quite high. So I think as long as PE is above 25, people will say, oh, it's overvalued now. So this is trailing PE, meaning that you look at the price level divided by the trailing 12 months earnings. So if we look at forward PE, right, so this is the price divided by the expected earnings over the next 12 months. The number is actually slightly lesser. So forward PE is currently at 22.5. So just focus on the blue line here. 22.5, if you compare against historical level, right, it's also quite high. Right before COVID, let's say about 2020, right, it was also about 22. And then the dot-com bubble level is also about 22 to 24. That was around year 2000, right? As you can see here, forward PE above, let's say like 20, that's considered highly valued already. So all these things, right, is quite hard to argue against. Like people say that, oh, market is overvalued. So I will agree that yes, market looks overvalued because you can feel the bullish sentiments, right? So this one, nothing to hide one. People can see all these numbers. But that's the thing. If you only focus on PE and then just want to time in and out, I think the things that you miss, right, is that the E itself is not constant one. The E or the earnings, right, it goes up over time. So as you can see here, if you focus on the price, right, which is the red line here, right, right now we are about at 22, right? But if you look at the blue lines, so this blue lines represents the earnings multiplied by, let's say like 10x, 15x, 20x, and 25x, right? So you see over a long period of time, let's say this chart here shows from 1985, you can see that the earnings doesn't go up in a straight line because from time to time we will have recessions, right? It may come down. And then right now, since 2020 until now, we have no recessions. That's why you see the blue line also keep going up, right? It's just that the red lines, which is the price level, it's not like it goes up at a constant PE, right? So in terms of PE, also slightly higher. That's why we have quite a decent rally since 2020. So you can see here, if you are trying to bet, like you say, oh, I want to buy when PE is low and then sell when PE is high, then if you do too much of this, market timing, right, you may miss the earnings, like this rally in terms of the earnings for a long period of times, right? So I would say that for those who really focus on buying for the long terms, right, actually what we are betting on is not saying that, oh, now PE is low and then if we buy now, if PE is high, then we get good returns over a short period of time, right? That is not what we are betting. We're actually betting that the earnings over time, over 5 years, 10 years, 15 years, 20 years, it will go up. So you can see here, the line is going up, right? So then if that one is going up, as long as PE doesn't go down in a huge magnitude, right, our portfolio will still benefit, right? And we are benefiting mainly from the earnings because earnings going up over time. So this is something that, it will say that PE is high, don't buy. But if you look at this chart, you will say that actually it doesn't matter. As long as we hold long enough, earnings go up, then we'll have a decent returns. So this is the chart. And then the other things to look at is that we shouldn't just focus on the earnings, right? We should also focus on what's the alternative, right? And the other alternative that is most common that people will invest in is definitely fixed income or bonds, right? You want to compare what is the return that you can get from investing in stocks versus investing in bonds. So let me just explain the chart here first. I think this one I've shown before, but for those who are new, right? So let's say if you look at the red line, right, that is showing the S&P 500 expected earnings. It's very simple because when we talk about PE, that's price divided by earnings. So the red lines here is showing the earnings divided by price. So it's just the inverse of the PE, right? So as you can see here, as PE going up, right? So the earnings yield also came down. So right now, earnings yield is about 4.44%. Definitely much lower as compared to, let's say, 3 years, 5 years, 10 years ago, right? So now at 4.44%. But if you look at the blue line, right? The blue line is actually showing the 10-year yield and then minus the 5-year expected inflations. The reason why they wanted to minus this 5-year expected inflation is to say that the 10-year yield, right, is actually a nominal yield. Nominal yields, that means that, let's say if you buy a 10-year bonds and you know that you are getting 4% return, right? This 4% return is fixed one. It is not going up based on the inflation one. But S&P 500, the earnings, right? If you look at the earnings divided by price for S&P 500, right now you are looking at 4.44%. Doesn't mean this 4.44% is a fixed return that you are going to get, right? Because these earnings over time it will go up, you see. So if you want to make it become a apple-to-apple comparison, you wanted to take the bond yield and then just minus out the inflations and get the real returns from the bonds. And because S&P 500, you can treat it as a real returns, right? Because at least the earnings will go up according to inflation. So then that's a more comparable comparisons. So if you look at the blue line here, after you take the 10-year minus out the 5-year expected inflations, right? You're actually just at 0.78%. It's even less than 1%. So that's why bonds looks good for those who needs the certainty in terms of the returns, right? But it's actually quite bad if you think of it from a real returns perspective, meaning that yes, you are getting be it like 3 or 4%, whatever numbers, right? That numbers, that yield is not going to go up following the inflations. So that's the main downside of investing in bonds. So as you can see here, although if you just look at the absolute level, 4.44% of earning yields from S&P 500, right, is still higher as compared to 10-year real returns, or let's call it like 0.8%, right? It's still higher than that. But if you just look at this difference, right, and this chart is showing the difference, this difference is the equity risk premium. And it is true that current level, this equity risk premium is lower as compared to, let's say, like 3 years, 5 years, 10 years ago. It is lower. But the good thing is that it is still positive, right? So that means if you invest in S&P 500, your long-term returns is still expected to be higher than investing in bonds. So this is still true, right? But in terms of like how attractive it is, if you compare to historical period where you can get like 6% earning equity risk premium, right? So the deal isn't as good anymore. That because of the markets getting more overvalued, right? So I think that's the situations now. I think the key takeaway here is that it is still more attractive as compared to bonds. So please don't invest like 90% of your portfolio in bonds, especially if you are young, right? So that's first thing. Second thing is that given that the price, the over earnings, right, the PE for S&P is already relatively high, you should expect a lower returns. And whether you name this as like a absolute returns or you see as a comparison against bond, right, it is less attractive now. So that's the key takeaway. All right, this chart, right, is showing the S&P 500 volatility index, or they could just call it VIX, right? I think VIX, just look at this chart, and maybe if I need to explain the technical definitions, I think it's a bit too lengthy. So I think you can just call this as like a fear index. As VIX become higher, people are fearful. And if VIX is very low, people are, they are bullish and they wanted to take risks. So right now, if you look at the level, right, it's about 14.8. So 14.8 is considered low as compared to long-term average, because long-term average is about 20, right? So we are currently about 15. Definitely this is usually, if you look at market rally, right, VIX will become low. And then let's say if there's any event, let's say any market indicators, or suddenly there's a drawdown in the market, right, this VIX, it will go up, it will go up to, let's say, like 25, 30, 35. And actually it happened quite a few times even in the past, let's say like 2 or 3 years, right? So even let's say the most recent one will be around April, when there's all this tariff fear, right? So VIX actually went up quite a fair bit. So if you look at VIX at, let's say, 14.8, right, definitely it is quite low now. And usually for those who want to time the market, right, if you want to buy, right, you don't want to buy when VIX is like 14.8, right? You wanted to buy when people are fearful. So by fearful, I mean you wanted to buy when, let's say, VIX is above 25 or above 30, right? So for those who like want to do a bit of timing, or you have a bit of cash you want to deploy and you wanted to, let's say, time your entry, right? One thing you can do is just observe the VIX. Let's say if the VIX is like, let's say, above 30, then you just need to pull your trigger and get into the market. And currently, it's just not a good time for you to, become aggressive. So just be careful when people are greedy now. You can see, right, from PE, from VIX, from equity risk premium that I just mentioned, right? It is quite clear that people are greedy. People, are having bullish sentiment on the market. And usually these are not the period that you wanted to 100% risk on. You wanted to take a step back and maybe have a bit more buffer. So I think that's sensible things to do. So that's my feel at the moment. If we break down the S&P 500, right, actually if you look at S&P 500, it went up. It's not like every company's, their price is at all-time high, right? It's not like that. I think it is quite clear that the one that is pushing pushing S&P 500 higher and higher is actually the Magnificent Seven, right? And it's not all companies in Magnificent Seven, because not every company is like rallying at the same time, right? But if you just take this S&P 500, the Magnificent Seven as a group, and the group that is like S&P 500 excluding the Magnificent Seven, you can see that there's quite a big diversion, like difference between these two groups, right? So if you look at the Magnificent Seven, actually the forward PE right now is at 29. The other group, right, the forward PE is only like 19.6. So it is like two different markets here, right? So one is even higher PE at close to 30. The other one is about 20. So very different. Then the question is that, are all these Magnificent Seven, they are, bubble, or is it like their valuations actually sensible? So let's look at some of the metrics, right? And remember, this is just a high level analysis. This is not like company by company analysis, right? Because if you wanted to know all these companies, you really need to go to each of the companies. So it's very surface kind of analysis here. So the first chart I'm showing here is the forward revenue growth. Okay, so this one is just to tell you that on average, the analysts, they are expecting Magnificent Sevens to grow at about 13% over the next 1 year. But for the other group, right, which is S&P 500 excluding the Magnificent Seven, right, the forward growth rate is only at 5%. So it's quite different already. Magnificent Seven, I guess, is mainly because of companies like Nvidia, right? Their growth rate is still quite strong. That's why it pushed up the forward growth rate for Magnificent Seven. So it's very different. The red line, right, is much higher as compared to the rest. The other one is that the forward earnings growth. So as I mentioned before, right, if the revenue is growing at a certain rate, usually the earnings is growing at higher rate. That's because of the operating leverage. So you can see here, Magnificent Seven, right, people are expecting them to grow at close to 18%. You see earnings, when it can grow by 18%, if they can sustain at this kind of level for, let's say, like 3 to 5 years, right, then your earnings level is actually much higher as compared to today's levels, right? But we don't know all these things, right? As you can see here, the red lines, it can go up and down, right? So, but it's still, at current moment, the expectation is high, is that they can grow at 80%. The rest is about, like, let's call it like about 11%. So still quite a decent difference, right, between this high growth, high earnings growth, high revenue growth, Magnificent Sevens versus the rest. Then the other one, which is even crazier, is the profit margin. If you look at the profit margins of this Magnificent Seven, right, you can see that their forward profit margins, right, is at close to 27, and the rest, right, is only at 12.2. So 12.2 versus 27 is like more than 2 times higher, right? So it's not only that this Magnificent Seven, right, they are expected to grow at a higher rate, earnings also growing at even higher rate, their profit margin is like also higher, and it is still going up. So you can see, right, it is like all the things is like, oh, the good stuff is all inside this Magnificent Seven. Then on top of that, even companies like, let's say, like Tesla, right, I think their robotaxi has been running for some time already. So far, there's no major issues. I think more, like, this story from time to time is like become even more promising. Even though if you look at their fundamentals, it's like not doing well, right? It's also like, but at least the story part is playing well. So you can see that yes, S&P 500 is really like pushed up by all these Magnificent Seven, but it's not like their price just going up and their fundamentals is like meh. It's not like that, right? If you look at their fundamentals, you will agree that they are actually, in terms of their quality, in terms of their metrics, they are all doing very, very well. That's why I would say that even though valuations is high, doesn't mean that it is a bubble. It just shows that people looking at all these companies and they recognize that their quality is better compared to the rest. That's why the valuation is also higher, right? It's to reflect the quality. So at least that's my view in terms of all these companies. That's why if you look at my portfolio, quite a number of them is actually like all these Magnificent Seven, right? That's because I recognize their qualities. It's not like we buy just because of market is going up. I buy because of like hype, right? It's not like that. It's really the fundamentals is supporting all this growth. The question is like, we can comment on today's fundamentals. The part that we can't comment is that what's the fundamentals of these companies 3 years, 5 years from now. That one is very hard to gauge, right? Very hard to guess. Everyone is guessing. Some will get it correct, some will get it wrong. I don't know whether I will correct or not, because like I have no crystal ball, right? But at least we can recognize their fundamentals up to this moment. Okay, then now, because I might have shared some conflicting message, right? I'm saying that, oh, market is overvalued, don't deploy too much, wait for the VIX to go up to 30. And on the other hand, I say that, oh, if you want to benefit from all these earnings going up, the entire economy become more prosper, right? We want to benefit, right? Then we should invest for the long term. So it's like conflicting message. So actually how I manage my portfolio is that, yes, there's the big pile, which is my interactive brokers, right? So that one is like kind of like my big ship, the main ship is there, right? Then the other pile is like all the smaller piles, right? Like I have some portfolio in Endowus here. So then I would say that for the big one, the IBKR, actually I am quite passive now. Like I shared in the past, right? I will invest more into like all these ETF and then just diversify. Let's say like now market is like pushing all-time high. My deployment into this IBKR is also like quite, like very minimal. Not much like I'm not invest as aggressively as like, let's say 2 years, 3 years ago, right? So definitely not aggressive on that now. But I want to remind myself that don't just, play too much of this, because if I suddenly accumulate too much cash and then become a drag over time, it is not a good investment strategy. That's why there should be a portions of my portfolio that is like completely passive, buy regardless of price level, just be very disciplined. And I find it that all these platforms like Endowus, right, because we can set up like all these DCA over time, right? Actually, Interactive Broker also you can do this kind of setup. It's just that I haven't done so. I just lazy to figure out that. But at least I have Endowus here. So this one is like invest my SRS money here, and every month, right, it's like really like consistently buying. So right now my portfolio, I think I shared my portfolio before. If you look at my YouTube, right, I actually shared before, but I forgot when was it already. Right now it's like 65,000 in Amundi Prime USA funds, 100%, very simple. Just invest in one fund only, right? And I just want to share with you like the progress of this portfolio. So if you look at the total investment value, right, so this is including the money that I put in and also including the gains that I got from this portfolio, right? This portfolio, by the way, started around December 2021, so almost 4 years already. And you can see, right, in the first, let's call it like one to 2 years, right, I've been investing consistently, and then in around midpoint there, I don't know what happened. Maybe it's like, sometimes it's like lost the like not as disciplined. Then I don't know why I go and pause the deployment. Maybe the money I went and buy treasury bill or whatnot. I forgot what's the story already. But there was a period where I stopped deploying and then I come back and deploy again. So you can see here the gray line, right, is showing how much money that I put into the portfolio, and then the blue line is of course the market value at the time. And as of today, it's like as I said, 65k. In terms of annualized internal rate of return, I don't know how they calculate it. I hope that they did a correct calculations here. It's at 18%. Wow, quite decent actually. But I guess mainly also because I invested in 2022, right? Because that was when the portfolio started, right? The entire 2022 I was deploying. So that was when the market was relatively low level. And then also early this year also deploying. So I think I caught that in terms of timing, is like I caught those period now. That's why the return is higher than, let's say, like the 10% average returns, right? So 18% is quite decent here. So in terms of gain, I already gained like 18k, but just a small portfolio here, right? It's not like this is like few 100k portfolio. Investment gain is like 18k by just, consistently deploying, except for the middle part, right? So please don't comment too much on that. At least now I'm consistently deploying. You can see the chart, right? So consistently deploying and not doing stock pick on this. It's just S&P 500, right? But I can't call it S&P 500 because this is Amundi fund and they didn't pay the S&P 500 licensing fee, right? They can't use the name. But essentially, this is very close to S&P 500 now. So I would say if you can't do your stock pick and you just want to do long-term investing, this kind of platform, I would say that it's actually quite a decent one. So you can just deploy and just do a truly robo kind of executions, right? Every month consistently deploy. The only one thing I would caution is that this portfolio, you shouldn't build it until like 1 million, 2 million using Endowus, because the fee that you pay, right, is not cheap one. So as long as it is like not a big figures, I don't mind paying the fee. And also I'm using this for my SRS, not my cash portfolio, right? This is how I do it. On one hand, I have a consistent portfolio that is deploying 2,000, as shown here, right? You can see 2,000 money every month, 2,000, get into this portfolio. And then on the other part, on my main portfolio, that one, sometimes I will slow down my deployment just because market is rallying, right? And let's say if there's any dip, then I might deploy more on those portfolio. That one, you can call it like a bit more active and aggressive. But here is like just consistent one. And I find that this kind of approach, right, like you have hybrid approach, right, can be quite, how to say, useful because you don't want to just all in into one strategy, right? Let's say even market rallying like this, on my cash portfolio, I have a bit of cash, but it's fine. At least here I have been deploying and I have benefited, right? So in terms of, do a bit of shout out here. So if you want to support me and you are interested in using Endowus as a platform, you can just scan the QR code here, and then I think you will get something like $20, and I also get $20 to offset my fee. So some support from you definitely is good. So thank you so much for those who scan the QR code and use this platform. The other thing is that I noticed that my video, right, you see my video, I don't usually ask you all to subscribe one. So I know that some YouTuber, every video is ask people to subscribe. I usually don't ask that too much, but I noticed that, okay, for those who are watching, around 1/3 is my subscribers, and there are 2/3 of you are new, right, to my channel, and you haven't subscribed. So if you are new to my channel, you are not subscribers yet, please subscribe, give a bit of support, and that would be appreciated. Thank you so much. See you in the next one.